Imagine for a second that you log into your bank account on December 31st. It's late, maybe you're tired, you are dreading it. You're expecting, maybe if you were disciplined this year, a modest increase.
Or just hoping you broke even, right?
Exactly, just hoping you broke even after a year of high inflation and all this economic noise. So you take a breath, you tap the app, and you look at the bottom line. You blink, you clean your screen, you look again.
You think it's a glitch in the matrix.
You absolutely do. You realize that you didn't just make a little more money. You made 3 times as much money as you did last year.
Wow.
We aren't talking about a margin of error here. We are talking about a complete, fundamental transformation of your financial reality.
It's the kind of moment that makes you call your accountant immediately, or maybe your lawyer, because you assume there must be a mistake, a bank error in your favor.
Exactly. But in the case we are covering today, there is no mistake. There is no bank error. That hypothetical scenario, that dream scenario, is exactly what happened to Burgan Financial Carolina A, or, as they are known in the market, Burgan Leasing.
That's right.
We are looking at their 2025 annual report and financial statements today. I've spent the last 3 days with this 100-page document, and the numbers are honestly staggering. Net profit skyrocketed from around 430 million TL in the previous period to over 1.25 billion TL in 2025.
It is a massive leap. And, it's the kind of leap that usually signals a one-time event, like selling a headquarters building or winning a massive lawsuit.
Sure, something that won't repeat.
But what makes this deep dive so interesting isn't just the what, that huge headline number, but the how. Because when you peel back the layers, it wasn't just about selling more leases. It wasn't just about volume. It was about a fundamental shift in how they manage their money, their debt, and their risk.
Welcome.
Good to be here.
Today, our mission is pretty straightforward, but it's going to take some serious digging. We are going to strip down this 2025 annual report.
Yeah.
We're going to translate those dense accounting tables, the ones most people just skip over, into a clear story for you, the retail investor. We need to figure out how they tripled their profit, and we also need to address the elephant in the room. There is a specific note in the independent auditor's report that caught my eye. A qualified opinion.
Ah, yes, that is a crucial part of the puzzle. Usually when an auditor, in this case KPMG, gives a qualified opinion, it's a red flag.
A big one.
It implies something is wrong or something is hidden or the books are cooked. It's usually a signal to run away.
Right.
But in this specific case, and I want to be very clear about this, it might actually be a sign of hidden strength. It might be the reason you should be looking closer.
That is a tease if I've ever heard one. A good red flag. When we get to the bottom of that.
We will.
But before we get to the hidden money, the auditor drama, and the triple-digit growth, let's first get to know the company a little. We need to ground ourselves in who Burgan Leasing actually is. It's easy to look at a ticker symbol or a company name and just see numbers. But there are real assets and real strategy behind this.
Context is everything. It really is. You can't understand the numbers if you don't understand the business model. You need to know how the machine works before you can measure its output.
Okay, so let's look at the identity and history. Burgan Financial Carolina A's has been around for a while. They were established on March 24th, 1994.
Yeah.
So we're looking at a company with over 3 decades of experience in the Turkish market.
Which is significant. I mean, think about that timeline, 1994. That means this company has navigated the 1994 economic crisis, the 2001 banking crisis, the 2008 global financial meltdown, the currency fluctuations of 2018 and onward.
Basically, every major storm.
Every single one. Surviving 30 years in any financial market is an achievement, but navigating the economic cycles of the last 3 decades in Turkey, that shows a serious level of institutional resilience. They have scar tissue, and in finance, scar tissue is valuable.
How so?
It means you know how to survive a storm.
They are headquartered in Levent, Istanbul, specifically in the ICE towers.
Yeah.
High finance territory. It's exactly where you'd expect a major financial player to be. But what stood out to me when I was looking through the contact codes and the branch listings in the report is their footprint. They aren't just sitting in a tower in Istanbul pushing paper.
No, and that's a key indicator of their business model. If you are a consumer bank or a tech company, maybe you can just exist in Istanbul or online. But leasing is tactile.
Tactile. I like that. They have branches listed in Ankara, Adana, Gaziantep, Bursa, Izmir, and Antalya. To me, that list looks like a travel itinerary for a really intense food tour.
Right.
You've got the kebabs in Adana and Antep, the Iskender in Bursa. But I assume there's a strategic reason for those specific cities beyond the culinary benefits.
Oh, absolutely. Although the food is a bonus for the branch managers, I'm sure. If you look at those cities, you aren't just seeing population centers. You're seeing the industrial and agricultural heartlands of the country.
The engines.
The engines of the real economy.
Break that down for us. Why Adana? Why Bursa?
Okay, take Bursa. It's the Detroit of Turkey. It's a massive hub for automotive manufacturing and textiles. You have huge factories there requiring millions of dollars of heavy machinery.
Right.
If you are a leasing company, you need to be in Bursa because that's where the machines are.
Makes sense.
Then look at Adana and Gaziantep. Yes, they have industry, but they are also critical for large-scale agriculture and food processing. Tractors, harvesters, processing lines, that's all leasing territory. Antalya. Tourism, yes, but also massive greenhouse agriculture.
So they're positioning themselves physically where the heavy machinery is needed. It's like they're setting up shop next to the construction site and the factory floor.
Precisely. Remember what business they are in. Leasing. You don't need a leasing branch in a residential suburb where people are buying groceries. You need it where the factories are expanding, where the construction cranes are going up, where the large-scale farming is happening. That branch network tells me they are deeply embedded in the production side of things.
They're financing the tools that build the country.
That's a great way to put it.
I think it's also worth noting the shareholding structure here. We often look at these companies as abstract entities, but who actually owns the keys?
Yeah, who's behind it all?
The report lists the main shareholder as Burgan Bank A, owning 99.99% of the shares.
Right, so it's a subsidiary. And that's important because it means they have the backing of a larger banking group.
Stability.
It provides a level of stability and potentially access to funding that a standalone, independent leasing company might not have. Burgan Bank itself is part of the KIPCO group, the Kuwait Projects Company, which is a massive regional powerhouse.
So you've got local expertise in Turkey backed by significant regional capital.
Exactly. It's a powerful combination.
And regarding governance, the report lists the board of directors. I always like to take a peek at who is driving the bus.
It's essential. You want to see experienced hands at the wheel.
The report lists the board members, and I noticed something regarding diversity. It seems they have a mix, but I specifically looked for female representation on the board.
Yes, checking the ratio of female board members is a standard governance metric these days, and for good reason.
Why is that?
Well, studies consistently show that diverse boards tend to manage risk better. They avoid groupthink. While the report lists specific names, what stands out is the stability. There haven't been chaotic shuffles in the boardroom.
And compensation. The compensation to key management section. I always check that. Are the bosses getting rich while the shareholders suffer?
A very important question. The report notes that compensation to key management benefits, wages, bonuses is disclosed. It's important to keep an eye on this to ensure it aligns with performance.
So what's the verdict here?
Given the 3x profit increase, one would expect management to be rewarded. If profits tripled and management bonuses stayed flat, I'd be worried they would quit.
Right.
If bonuses went up 10x, I'd be worried they were looting the company. The report doesn't show an excessive spike that would worry me. It seems proportional.
That leads us perfectly into defining what they actually do. The report states they operate only in Turkey and only in financial and operational leasing. For the learner listening who might hear leasing and just think of renting a car for a weekend or maybe their apartment lease?
Yeah, it's a different world.
Can we break down what financial leasing or financial kiralama actually means in this corporate context?
Think of it as rent to own for businesses, but on a much, much larger scale.
Okay.
Let's make it concrete. Let's say you own a textile factory in Bursa. You have a great year, you have orders coming in from Europe, and you need to expand capacity. You need a new state-of-the-art weaving machine. That machine costs, let's say, 10 million lira.
Okay, I need 10 million lira. I can check my bank account, but let's assume I don't want to drain my cash reserves.
Exactly. That's the key. You could buy it with cash, but that drains your working capital. If you have a bad month later, you have no cash left to pay salaries.
Right.
You could go to a standard bank and ask for a loan, but that uses up your credit limit, and banks can be slow, and they might require you to mortgage your factory building as collateral.
Or I go to Burgan.
Right. You go to Burgan Leasing. And here's the difference. Burgan buys the machine. They pay the manufacturer the 10 million lira. Burgan owns the machine. It is on their books as an asset.
I see.
Then they rent it to you for, say, 5 years. You make monthly payments.
So I get the machine immediately. I start making money with it, but I don't own it yet.
Correct. For the duration of the contract, Burgan is the legal owner, but you are the economic owner. You are using it to generate profit. And here's the kicker. At the end of the contract, after you've made all your payments, for a very nominal fee, sometimes just a symbolic amount, the ownership transfers to you.
It seems like a lower risk model for the lender than just handing someone cash.
In many ways, it is, and this is crucial for understanding Burgan's risk profile. If you lend someone 10 million lira cash and they go bankrupt, you have to get in line with all the other creditors and hope to get pennies on the dollar.
A huge headache.
But if Burgan leases you a machine and you stop paying, they don't have to sue you for the money. They just send a truck and take the machine back. They own it. The asset itself is the collateral.
That makes sense. It's a secured lending model by default.
Exactly. It's a way for companies to finance their capital expenditures, or CapEx, without dropping a massive amount of cash up front. And for Burgan, it provides a stream of income backed by physical assets.
So, given that they tripled their profits in 2025, we can assume the sector, or at least Burgan's slice of it, was active. Let's do a quick SWOT analysis based on what we found in the 2025 performance to wrap up this profile before we dive into the ledger. Strengths.
Capitalization, hands down. Their equity is nearing 5 billion TL. We will talk about this more later, but that is a massive buffer. That is a fortress. Also, their ability to generate what the report calls other income, which we will unpack, is a huge strength.
Right. They aren't just relying on interest payments.
Not at all.
Weaknesses.
I'd point to the operational cash flow volatility.
Yeah.
As we saw, it dropped significantly in 2025. It's not necessarily a sign of failure. In fact, as we will see, it was a strategic choice.
It's a deliberate choice.
A very deliberate choice. But technically, having low operating cash flow is a vulnerability if liquidity tightens suddenly in the market. If you need cash now and you just spent it all paying down debt, you have fewer options.
Opportunities.
The expansion in industrial zones, that branch network we talked about. If the Turkish manufacturing sector grows, if the Turkey as a manufacturing hub thesis holds true, Burgan is positioned to capture that growth in Adana, Gaziantep, and Bursa better than a bank sitting in Istanbul. They are on the ground.
And threats.
Economic fluctuations. This is the big one. The report explicitly mentions the need for free provisions because of potential negative developments in the economy and markets.
We're going to get to that.
They are acutely aware that if the economy sneezes, their clients might catch a cold, and if their clients catch a cold, they stop making lease payments.
Right. If the textile factory in Bursa loses its European orders, it stops pulling for the weaving machine. Burgan is directly exposed to the health of the real economy.
That's their biggest risk. Always.
Now we can move on to our analysis. Let's get into the numbers.
Fun part.
I want to start with the top line. Revenue. When you hear profit tripled, you assume sales tripled. You assume they just did 3 times as much business.
That's the logical assumption, yeah.
But the report shows interest income rose from about 1.1 billion TL in 2024 to 1.37 billion TL in 2025.
It is a healthy increase. It's about a 24% increase. In a vacuum, that's good growth. It shows their core business, the money they earn from those leasing contracts, is expanding. They are signing deals, collecting payments.
But, and here's the aha moment for me, revenue went up by roughly 270 million TL. But profit went up by over 800 million TL.
The math doesn't work.
The math doesn't add up if you only look at sales. You cannot generate 800 million in new profit from only 270 million in new revenue. It's physically impossible.
Exactly. If you only look at the top line, you miss the real story of 2025. You are looking at the tip of the iceberg.
So where's the rest of it?
To find the profit, you have to look at the expenses. You have to look at what they didn't spend.
Okay, let's look at the interest expenses line. This is the cost of the money they borrowed to buy those machines. In 2024, they paid out roughly 2.35 billion TL in interest expenses.
Yeah.
That is a huge chunk of change.
It's massive. In 2024, think about that ratio. They brought in 1.1 billion in interest income, but paid out 2.35 billion in interest expense.
So they were losing money on their core business.
Their core financing operation was seemingly underwater before other income sources? Yes.
But look at 2025. That number dropped to approximately 826 million TL.
That is the collapse. That is the profit driver.
I mean, that's not just a trim, that's a slash. They reduced their interest expense by nearly 65%. How does a financial institution do that? Did interest rates in Turkey drop by 65% in 2025?
No. Definitely not. Market rates did not drop by that magnitude. This implies a major restructuring of their liabilities.
What does that mean in simple terms?
They likely paid off expensive debt that they were carrying from previous years. Think about it. If you are carrying a credit card balance at 40% interest and you pay it off using cash you have on hand, your monthly expenses plummet immediately.
Right.
Burgan likely used their liquidity to deleverage, getting rid of high-interest loans.
So while their revenue went up a respectable amount, their cost of goods sold, or in this case, the cost of money, fell off a cliff.
Correct. And that creates a massive expansion in the gross profit margin. In 2024, their interest expense was significantly higher than their interest income.
They were in the red on the spread.
They were relying entirely on other income sources to stay afloat. In 2025, income is significantly higher than expense. They flipped the core economics of the business back into the green. They are now making money on the spread again.
That is a turnaround story right there. Just fixing the spread is a huge win. But there's another number jumping out at me. We mentioned other income.
Yes.
The report lists other gains, or Elda Edelin Dijer Kazanslauer, at a staggering 1.7 billion TL.
Yes, this is the turbocharger. If the interest expense cut was the engine repair, this is the nitrous oxide.
That is more than their interest income. What is this? Is it sustainable?
The report groups a few things here. In leasing companies, this line item is usually a mix. It can come from foreign exchange gains. If they held assets in dollars or euros and the lira depreciated, the value of those assets goes up in TL terms.
Okay.
But often, and more significantly, this comes from the sale of assets.
Selling the machines.
Either selling the machines at the end of the lease, or perhaps selling a portfolio of leases to another bank, or selling off repossessed equipment at a profit. Given the magnitude, 1.7 billion, it suggests they were very active in managing their asset base.
So they weren't just holding on to things, they were monetizing them.
Exactly. It implies they might have realized gains on assets they had held for a while, taking advantage of market prices.
So you have this triple threat driving profit, solid growth in core leasing income, a massive collapse in interest expenses due to paying off debt, and a huge injection of cash from other gains.
And when you combine those three, you get that bottom line number, 12,250,692,000 TL in net profit.
It's incredible. And just to contextualize that for the listener, imagine you run a lemonade stand.
Okay.
You sell a bit more lemonade than last year. That's nice. But suddenly the price of lemons drops by 70% because you paid off your lemon supplier debt, and you also happen to find a gold bar on the sidewalk next to your stand. That's Burgan's 2025.
That is a surprisingly accurate analogy. The gold bar being the other income, and the cheap lemons being the reduced interest expense. It's a confluence of good management and good fortune.
So everything looks perfect. The table is set for a celebration. Champagne corks should be popping.
Should be.
But then we open the independent auditor's report. This is prepared by KPMG, one of the big four accounting firms. Serious people. And right at the top, in bold letters, it doesn't say clean opinion. It says, Sanirler Olumlu Garush.
Limited positive opinion, or in standard audit terms, a qualified opinion.
Limited positive sounds like a backhanded compliment, like telling someone, you look good for your age, or that dress is interesting.
Exactly.
Why did the auditor dampen the mood?
Usually you get a qualified opinion when the auditor thinks you are lying, or when you lost the receipt.
This is where we get into the red flag that isn't really a red flag. It's fascinating. The issue is something called a free provision, or Sir Best Karshalik.
Let's unpack this. The report says Burgan set aside 145 million TL as a provision. Right. Specifically, the report details that they had set aside roughly 612 million TL in previous periods. In 2025, they canceled about 467 million TL of it, likely reversing it into income, leaving a net total of 145 million TL in this free provision bucket, still sitting on the balance sheet.
Okay, so let's clarify what a provision is for the non-accountants. Usually you set aside money at provision because you know a loan is going bad. You say, Factory X isn't going to pay me back 10 million, so I will record a 10 million loss now to be safe.
Correct. That is a specific provision. It is tied to a specific bad event that has happened or is happening.
But this is a free provision.
A free provision is when management says, look, I don't know specifically who is going to default. I don't have a specific bad loan, but I look at the economy, I look at inflation, I look at the geopolitical situation, and I get a bad feeling.
Okay.
So I am going to take 145 million TL of my profit and set it aside in a general rainy day fund, just in case.
To me, that sounds responsible. That sounds like good parenting, saving for an emergency. Why is KPMG upset about it? Why are they wagging their finger?
Because accounting standards Specifically, the BRSA and TMS regulations are very strict about truth in advertising. In accounting, you are generally only allowed to set aside money for a loss that has already happened or is measurably certain to happen.
You can't just go on a feeling.
You can't just say, I have a bad feeling about 2026, so I'll hide some money now.
I see. Because if you can hide money when you have a good year,
You can release it when you have a bad year to make your bad year look better.
it's manipulation.
It's called income smoothing. Auditors hate it because it distorts reality. It makes volatile businesses look stable.
I see.
KPMG is saying, look, Burgan, you earned that 145 million TL. It should be in the net profit line. By hiding it in a provision, you are actually understating your profit.
That is the irony, isn't it? Usually when you hear about accounting scandals, Enron, Wirecard companies are trying to overstate profit.
Yes, always.
They are trying to pump the stock price by pretending they made money they didn't make. Burgan is doing the exact opposite. They are saying, we made too much money, let's hide some under the mattress so we don't look too flashy and we have it for later.
Which brings us to the takeaway for the retail investor. If you see a qualified opinion because a company is inflating its assets or hiding bad debt, run away. That is a siren.
Absolutely.
But if you see a qualified opinion because the company is being too conservative, because they are hiding extra cash for a rainy day, that's arguably a good thing for you as a shareholder.
It means the balance sheet is actually stronger than it looks.
It means that the 1.25 billion profit is actually closer to 1.4 billion if you followed the strict rules. They are sandbagging. And in a volatile economy like Turkey's, where things can change overnight, I'd rather invest in a company that sandbags than one that exaggerates.
So the red flag is actually a green flag in disguise, proving that management is prioritizing long-term stability over short-term accounting perfection.
Management explicitly states in the report that they did this due to possible negative effects of future economic and market developments.
Right there in black and white.
They are looking at the horizon and seeing storm clouds. So they are buying umbrellas now while they can afford them. It tells me they are cautious. They aren't drunk on their own success.
Smart. Now let's move to another mystery in the report. We talked about how profitable they were. We talked about the huge net profit. But when I looked at the cash flow statement, my heart skipped a beat.
The cash flow statement is where the truth usually lives. Profit is an opinion. Cash is a fact.
Well, the fact looks scary for a second. In 2024, their net cash flow from operating activities was positive 1.34 billion TL.
A cash machine.
A cash machine, money pouring in. But in 2025, that number dropped to just 96 million TL.
That is a 93% drop in operating cash flow.
If I just saw that headline, cash flow collapses by 93%, I would panic. I would sell the stock.
Of course.
How can you have record profits but almost zero cash flow? Is it fake profit? Are they not collecting the bills?
This is a classic example of why you have to read the line items. You have to look at where the cash went. It didn't vanish into thin air. It wasn't lost in a casino.
So where did it go?
Look at the line item in the cash flow statement. Loans received paid, or Alenin Krediler. Specifically, section 1.2.9, Alenin Krediler deki net artish azalış.
I'm looking at it. It shows a negative number. 1,501,608 TL. So 1.5 billion TL outflow.
That is the answer. They use their cash to pay down debt, a massive amount of debt.
Okay, I need a metaphor here to help visualize why this makes cash flow look bad but is actually good.
Imagine a family. Let's call them the Yilmaz family. In 2024, Mr. Yilmaz had 100,000 lira in his checking account. He felt rich.
Okay.
But he also owed the bank 500,000 lira on a high-interest loan.
Okay. High cash but high debt.
In 2025, Mr. Yilmaz gets a huge bonus at work. He brings home record income. He has a great year. But instead of letting that cash sit in the checking account or buying a new car, he takes almost all of it, let's say 90% of it, and transfers it to the bank to pay off his loan.
So at the end of the month, when he looks at his checking account balance,
It's almost empty. It went from 100,000 down to maybe 5,000.
so if you only look at the checking account, which is the cash flow statement, you might think, oh no, the Yilmaz family is broke. They have no cash.
Exactly. But if you look at their net worth, the balance sheet, they are wealthier than ever because they don't owe the bank anymore. They eliminated a liability. They are financially freer.
That is exactly what Burgan did. They took that massive profit and used it to clean up their balance sheet.
And that explains the drop in interest expenses we talked about earlier.
It all connects.
They paid off the loan, so now they don't have to pay the interest. It's a virtuous cycle. They sacrifice liquidity today for profitability tomorrow.
It really paints a picture of a company that is hunkering down. They are building a fortress. They aren't interested in looking flush with cash. They're interested in being debt-free or closer to it.
Fortress is the right word. Let's look at the shareholders' equity to confirm this. This is the ultimate measure of the company's net worth.
Total equity increased from 3.1 billion TL to 4.9 billion TL. That is nearly a 60% jump in their net worth in 1 year.
That is enormous growth. For a mature financial institution to grow its book value by 60% in a single year is rare. And look at the paid-in capital. It stayed flat at 470 million TL.
What does that tell us?
It means this growth wasn't funded by asking investors for more money. They didn't do a rights issue. They didn't dilute the shareholders. Sometimes you see equity go up because the company sold more stock. Here, the paid-in capital didn't move. This was pure organic growth from retained earnings. They earned the money and kept it in the company.
The equity-to-asset ratio must be looking great.
It's strengthening significantly. They are funding their business more with their own money and less with the bank debt. That makes them much less vulnerable to interest rate spikes in the future.
Right.
If rates go to 50% or 60%, Burgan doesn't care as much as they used to because they aren't borrowing as much. They are their own bank now, in a way.
I noticed something else in the equity section regarding dividends, or rather the lack of them. A lot of investors see a record profit and think, great, big dividend check coming.
Yes, the natural expectation.
But there's a line about transferring 1.38 billion TL of previous profits to reserves.
That aligns perfectly with the conservative theme. They aren't paying out a massive cash dividend to celebrate. They aren't buying yachts. They are taking that profit and locking it into the company's reserves.
A war chest.
They are building a war chest.
It feels like they are preparing for something. You don't clean your house, this thoroughly paying off debt, hoarding cash in reserves, hiding provisions, unless you are expecting guests, or you are planning to renovate, or you are scared of a storm.
Or unless you're expecting a storm. Remember the free provision. Management is clearly wary of the economic environment.
They said it themselves.
They have deleveraged, stocked up on cash reserves, and reduced their burn rate. If 2026 is a tough year for the Turkish economy, if inflation spikes again, or if there is global instability, Burgan Leasing is positioned to be the last man standing.
Let's delve a bit deeper into the operational side of things before we conclude. We mentioned investments in new projects in our outline. Did you see anything in the report about where they are spending money, aside from debt repayment?
The report is fairly disciplined here. They aren't announcing flashy new headquarters or experimental ventures. The investments are largely focused on maintaining their core infrastructure, likely IT and digital transformation, which is standard.
Nothing crazy.
No, but the real investment is in their balance sheet. By retaining earnings, they are effectively investing in their own capacity to lend in the future.
And what about market share? The report mentions their position. Are they growing relative to the competition?
The leasing sector is competitive. You have bank-affiliated leasing companies like Burgan, and you have independents. Burgan emphasizes their customer-centric approach. While they don't provide a precise market share percentage down to the decimal point in the summary we have, the 24% revenue growth suggests they are at least keeping pace with inflation and likely capturing share from weaker competitors who can't afford to lend right now.
Because if you are a small leasing company and you have to borrow at 50% to lend at 55%, your margins are razor thin. Burgan, by paying off debt, can perhaps lend more competitively.
Exactly. Their cost of funds is effectively lower because they are using their own equity. That is a massive competitive advantage. While others are struggling to find liquidity, Burgan is sitting on a pile of equity.
Let's touch briefly on the management commentary and future outlook section of the report. Is there anything there that confirms our fortress theory?
Oh, absolutely. The report emphasizes managing risks against economic fluctuations. It's a recurring theme. They talk about sustainable profitability rather than aggressive growth.
Not growth at all costs.
No. And they mention the importance of their branch network in maintaining close relationships with customers. It's a very grounded, sober outlook. They aren't promising the moon. They are promising stability.
Which, for a retail investor, can be quite boring, but also quite beautiful. Boring is good when it means your money is safe.
Boring is beautiful in finance. Excitement usually means you lost money or took a crazy risk. Burgan is trying to be the boring, reliable machine that prints money.
I want to circle back to the shareholding structure briefly before we wrap up. The report mentions the board and executives. Is there anything notable there?
The report lists the board members, but it doesn't flag any major changes in control. It's a standard corporate governance structure. However, looking at the compensation.
Yes, compensation to key management. We touched on it, but is there more to say?
Just to reinforce the point, given the 3x profit increase, the compensation seems proportional. They're not being greedy. If bonuses went up 10x, I'd be worried they were looting the company. The report doesn't show an excessive spike that would worry me.
And regarding the board diversity,
The report lists the names. It's always good to check the ratio of female board members as a governance metric, as diverse boards tend to manage risk better. The broader takeaway for the investor, though, is stability.
the same team is at the helm.
The same leadership team that navigated the volatility of previous years is steering the ship now. They know where the rocks are.
So we've unpacked the report. We've solved the mystery of the disappearing expenses and the hidden provisions. We've explained why the cash flow looks empty, but the vault is full. Now, the big question, the so what?
Yes.
What does this all mean for the listener?
If you are a retail investor looking at Burgan Leasing, you are looking at a company that had a fortress year. They achieved the holy grail of finance. They grew their net worth while reducing their risk.
Which is almost unheard of.
Usually, to get higher returns, you have to take higher risks. Burgan managed to get higher returns while lowering their risk profile
They slashed their costs.
drastically,
They paid off their debts.
aggressively.
And they put money aside for a rainy day, even if the auditor grumbled about the paperwork.
Exactly. They prioritized long-term survival over short-term accounting perfection.
So if I'm holding this stock or thinking about it, I'm looking at a company that is leaner and meaner than it was a year ago.
Much leaner. Their break-even point is lower now because they don't have that massive interest bill to pay every month.
Right.
That means even if revenue drops in 2026, even if the economy slows down, they can likely still remain profitable. That is a safety margin that most companies don't have.
That's a huge deal.
Most companies need to keep growing just to pay the interest on their debt. Burgan doesn't.
Here is where it gets really interesting for me. We have this company with a clean balance sheet, low cost of funds, and a massive equity base. What happens next?
That is the provocative question, isn't it?
Are they just going to sit on this pile of money?
Mhm.
Or are they preparing for a move?
When you have this kind of balance sheet strength in a sector that is generally struggling with high interest rates, you become a shark.
A shark.
You are the apex predator.
Go on.
You can acquire smaller competitors who are drowning in debt. You can buy asset portfolios, thousands of machines, at a discount from companies that need cash. Or you can aggressively undercut competitors on pricing because your cost of funds is lower. You can offer cheaper leases than anyone else and steal their customers.
So 2025 was the year of cleaning up. 2026 could be the year of the offensive.
It's very possible. With 5 billion TL in equity, they have the firepower to double their market share if the opportunity presents itself.
And if things go bad,
Or if the economy tanks, they have the firepower to survive while others fail, leaving them with a bigger slice of the pie when the dust settles. Either way, they have positioned themselves in the driver's seat.
wow.
They aren't passengers in the economy anymore, they're driving.
That is a fascinating thought to leave you with. Burgan Leasing didn't just have a good year. They reset the game board in their favor. Whether they play defense or offense next remains to be seen, but they definitely have the chips to play.
Absolutely. It will be a very interesting year to watch.
If you enjoyed this breakdown and you want to see us decode more annual reports, because let's be honest, you aren't going to read them yourself, please hit the like button.
Please do.
It helps more than you know. It tells the algorithm that smart people are watching, and it helps us find more smart people like you.
And we like smart people.
Don't forget to subscribe so you don't miss the next deep dive. We have some interesting companies on the list for next week, including some in the energy sector that are showing similar patterns.
Indeed. Energy's the next frontier.
If you want to support us in making these ongoing videos and keeping the lights on in the studio, please evaluate our channel membership options. It really makes a difference and allows us to spend the time digging into these 100-page reports.
It allows us to dig deeper.
And remember, you can always show support with a super thanks right below this video. It's the digital equivalent of buying us a coffee to say thanks for reading the footnotes so you didn't have to.
Which we appreciate.
See you in the next one.